Ray Dalio is here. He's the founder of Bridgewater, chairman, chief investment officer. We're always thrilled to see you and spend time with you here in Davos, and always get your ideas about where you think the market is and how the machine, you've always talked about the machine and your principles work right now. So where are you?
So I think let's particularly talk about the U.S., but I think it's generally true of the world. We are in this Goldilocks period right now in which we have had a beautiful deleveraging. The inflation isn't a problem. Growth is good. Everything is pretty good, with a big jolt of stimulation coming from the changes in tax laws and such. That is going to, at the part of the cycle, we're at the later part of the cycle. So if you look at the operating rates and you look at the GDP gap and measures, we're going to have a jolt of stimulation into that. And there's a lot of cash on the sidelines. I don't mean just investor cash. I think banks have a lot of cash. Corporations have a lot of cash. So we're going to be, I think, inundated with cash. I think that that's going to produce a lot of stimulation, and I think perhaps a market blow-off. In other words, we're in a situation where if you're holding cash, you're going to feel pretty stupid. And with that, everybody is going to become more deployed. Classically, this is late cycle behavior. And as you get that movement, then the interesting question is, how does the Federal Reserve react, or how do other central banks react? I think it's a very difficult thing to get monetary policy precise. Oh, that's why we have recessions, because you never can get it exactly right. I think it's particularly difficult to get it right now because of the fact that with interest rates so low, all assets trade at the present value of the future cash flows, so interest rates affect all assets. Because the duration of bonds and debt has lengthened, it just takes a little change in interest rates to have a bear market. And so the things that we look at are, in terms of the tightening of monetary policy, will it be tighter than is discounted in the curve, right? We have a very small amount of tightening which is built into the curve. If it is greater, and interest rates rise are greater, that can affect all asset prices.
But you're not necessarily talking about 4 moves instead of 3. You're talking about something a little greater than a quarter percentage point off, right?
It's all a matter of degree, right? We are entering that part of the cycle, right? That last part of the cycle. That last part of the cycle, I think, can last a year. But I would say when we come back here next year, probably when we're dealing with it, the issue of the preciseness of monetary policy, the delicacy, is going to be a particular issue. So I think that you're going to get a reaction. I think that the Fed should think about how much of it is this jolt to stimulation, and they should let it go. That the notion of inflation worry, what is the problem with inflation? They're struggling to get it to 2%. All the central banks are struggling to get it to 2%. We're not going to probably even hit a core inflation rate of 2% because there are other things that are happening in the economy. So let it go, enjoy it, but probably we're entering
then you got to get the last segment. But if this is the last leg, not only does the Fed have to get it right, you as the investor have to know when to be in and then clearly when to be out.
That's my game. Right. I mean, that's right. I got to know it. We all got to know it.
So, Ray, we need to recalibrate what we think is a high interest rate and what is a low interest rate, because even if, like, historically, I'm just conditioned to think that, I don't know, I'm used to 6 and 7%. So this time 5% could be high, and that could be enough to dislocate. So we need to recalibrate.
I think to calibrate it, you have to ask, what does it mean for asset prices first, and then what does it mean for economic activity? If you look at asset prices, if they're all calculated as the present value of future cash flows. So if the bond market goes down, to put that in perspective, if there's a 140 basis point rise in bond yields, you will have the greatest bear market in bonds ever. The biggest bear market. Because and when you
even though we're still at a relatively low level historically.
You can't have a significant rise in interest rates without knocking over the whole asset markets. All markets, private equity, real estate, everything in terms of markets is trading at cap rates or yields that are very low. If all of a sudden you raise the discount rate on that, they're all going to go down, right? So you have a sensitivity from asset prices. The average increase in the tightening cycle has been about 500 basis points. I don't think you can have 100 or 125 basis points from here without knocking it over. The same thing is true.
Just to put a fine point on it,
Yeah.
Joe mentioned 5%. You're talking 4% potentially, like for.
Yeah, I don't think you can get.
Yeah.
Okay, and then so for asset prices, and then if you look at the nature of, there has been a leveraging up of many parts of the company. Corporations, the return on equity was high relative to the return on cash, so the typical companies leveraged 2 to 2.5 times what they were before. Now, did they get that right? Okay, that's the key thing. So what, you're going to have a sensitivity to that. You still have a fair amount of debt. So there's a lot of sensitivity, much more sensitivity to interest rate changes than there has ever been.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.